I would now like to focus on inflation. Inflation increased sharply in September and October 2024, led by an unanticipated increase in food prices. Core inflation, though at subdued levels, also registered a pickup in October. Fuel group remained in deflation for the 14th consecutive month in October. In the near term, despite some softening, lingering food price pressures are likely to keep headline inflation elevated in the third quarter, that is, in the quarter October to December. Going ahead, a good Rabi season would be critical to the softening of food inflation pressures. Early indications point to adequate soil moisture content and reservoir levels, conducive for Rabi sowing. The estimates of record Kharif production should bring relief to elevated prices of rice and tur dal in particular. Vegetable prices are also expected to see a seasonal winter correction. On the upside, the evolving trajectory of domestic edible oil prices following the hike in import duties and rise in their global prices need to be monitored closely. Manufacturing and services firms surveyed by the Reserve Bank point to firming up of input costs and selling prices in the fourth quarter of the current financial year, that is in the quarter January to March. Taking all these factors into consideration, CPI inflation for the current financial year, that is 24-25, is projected at 4.8%, with Q3 at 5.7%, Q4 at 4.5%. Going into the next financial year, CPI inflation for the first quarter of 25-26 is projected at 4.6% and Q2 at 4%. The risks are evenly balanced. Now, what do these inflation and growth conditions mean for monetary policy? I have described the growth conditions. I have described the inflation conditions. Now, what do all these factors mean for monetary policy? And that is what I would like to now highlight. The near-term inflation and growth outcomes in India have turned somewhat adverse since the last monetary policy in October. The medium-term prognosis on inflation suggests further alignment with the target, while growth is expected to pick up its momentum. Persistent high inflation reduces the purchasing power of consumers and adversely affects both consumption and investment demand. The overall implication of these factors for growth is negative. Therefore, price stability is essential for sustained growth. On the other hand, a growth slowdown, if it lingers beyond a point, may need policy support. The Reserve Bank's anti-inflationary monetary policy stance has been a crucial factor in bringing about a significant disinflation. Going forward, as food price shocks wane, headline inflation is expected to ease and realign with the target as per our projections, which I just read out. At present, it is necessary to draw on the flexibility provided by the neutral stance of monetary policy to wait for and monitor the incoming data for confirmation of the decline in inflation. The gains achieved so far in the broad direction of disinflation, notwithstanding the recent upticks, need to be preserved. At the same time, the growth trajectory and the evolving outlook also need to be monitored very closely. At this critical juncture, prudence and practicality demand that we remain careful and sensitive to the dynamically evolving situation with all its complexities and ramifications. A status quo in monetary policy in this meeting of the MPC has thus become appropriate and essential.